This is News You Can Use.
Jamie Dimon, CEO of JP Morgan, one of the largest investment banks in the world, said this past weekend that we're experiencing an unprecedented environment when it comes to economic forecasting. It's more challenging than ever. Well, today's guest is responsible for economic forecasting at Fannie Mae, the biggest housing financier in the world. Doug Duncan, welcome to News You Can Use.
Thanks for inviting me.
Yeah, we're glad you took the time today. Doug, do you agree with Jamie that today's environment is the most, let's say, unprecedented, complex for an economic forecast?
It is. I do agree with that. And it is primarily because the driving factor is fear of a disease and presence of that disease. It's not an economic phenomenon. It's more of it's a health and a psychological phenomenon which is affecting behavior.
So normally as a forecaster, and obviously you've been at this for a while as your team, as you're responsible for your team, what are the key inputs that you all consider normally when you're thinking about the overall economy and housing? What are those key inputs from a forecaster standpoint?
Well, we're looking at things that affect economic growth. So those things are consumption, investment, government spending, all of which are related to employment and income. So what's happened this time that makes it so difficult is the fear of the disease has led middle and upper income households to retract spending on what is discretionary consumption. So that discretionary consumption is theaters, sporting events, airplanes, hotels, those kinds of leisure activities, which you don't have to do those things, but if you have that discretionary income, you do it. What that led to is a tremendous increase in unemployment among service sector workers that provide the output that's consumed in those spaces. Those tend to be hourly wage workers, not salaried workers. So you can kind of see where the impact of that is.
So if what's normal is tracking all of the inputs that affect employment as the key kind of propeller for the economy, whether it's overall or in housing, what are you adding in now from an input standpoint that COVID has showed up when you're thinking about your forecast?
We've actually changed the terminology to some degree to reflect how we are thinking about the various models that we run. So what we address now is our baseline scenario. It suggests that there's less certainty about the interrelationships that we've seen in the past in economic activity, and therefore, and it's because that less certainty exists because it's driven by something that's outside normal economic models, and again, that's the disease. So we daily look at the things that you and I have talked about, which is the infection rate, the hospitalization rate, those kinds of things, to try to understand how that will affect people's psychology. Will the change in the incidence, duration, and severity of the disease impact their behaviors? And if so, then we have to adjust our scenario. That's why you're hearing people talking about, is it going to be a V-shaped recovery or a W-shaped recovery or an L-shaped recovery or a Nike swoosh, or all the economists are saying a radical, which is a square root symbol.
That's the latest in the order of what's possible for the recovery. So let's shift to what your forecast is actually telling you now. I know you recently updated your forecast for 2020 and 2021. Talk us through, based on the unprecedented environment and all of the inputs, talk us through where you all see both the economy and then more specifically where you see housing going next.
On economic activity, our thought is that the economy will shrink. That is, it will be smaller at the end of 2020 than it was in 2019 by between 4 and 5%. So that's a big move. typically economic activity moves 2 to 3% and in an upward direction. And in a normal recession, it wouldn't fall nearly that much. So it doesn't sound huge numerically, but it's actually a big drop in economic output. What that suggests is that at the end of the year, that is 2020, unemployment will be somewhere in the 8 to 9% range, and then even next year, this will be a slow recovery. Even at the end of 2021, we would expect unemployment still to be in the 7% range. Both of those numbers depend a lot on the response to the rise in the virus in the South geographically. Housing has done better. That is, purchase and refinancing of housing has done better by quite a bit than people expected. You and I have talked over the last couple of years about if there's a downturn, housing is likely to be the cushion to that downturn because of the slower growth of supply relative to demand. That's turning out to be true. So once in a while, when you get it right, you like to don't look surprised. So that's turned out to be true. House prices have actually risen because concerns among people who could list their homes for available sale have been greater than those who've seen the low interest rates and have an interest in buying. So that imbalance between the drop in supply and the drop in demand has meant house prices actually have risen. So we expect overall this year about an 11% decline in, I think this is, about 11% decline in existing home sales and about a 2.5% decline in new home sales across the course of the full year. So still a pretty good environment given what's happened. If you're in the rental side of the business, that's where the stress is going to be. Is that the hourly wage workers are primarily renters.
So it's been resilient housing, and we went into the year, and one of the obstructions, because we had the lowest unemployment rate ever when we started the year, and we had the lowest interest rates ever that we both talked about, and then we were talking about the housing market maybe doing a 2% or 3% increase. You actually had a 2.7 number going into 2020. And then, of course, we had COVID and unemployment has gone to 11. I think a lot of us in housing have been surprised by the resilience. Is that because there was just not enough inventory of houses to sell, but there was a lot of buyers that were out there? And to your point, the employment that we've lost has been in the lower income sector. Is that how we should think about it?
That's right. Typically, house prices in what I would call a market where it's evenly balanced between the demand side and the supply side. So there's available supply for people that are qualified to make purchases. Typically, house prices in that environment, if you adjust them for inflation, would rise about 0.75% annually. Then you add in the rate of inflation, you get to what the nominal price increase is. We've been seeing for over 5 years, we've seen house prices appreciate inflation adjusted at a much stronger pace than that, simply because the millennials were moving in as the buyers and supply was not growing as rapidly. So that was entering this period. Interest rates now have dropped, obviously dramatically, first of all because of the drop in economic activity, then because the Fed moved their target for interest rates down. But we actually are expecting rates to fall further. So the question is, why do we expect that? Well, if you look in April, the spread between the 10-year Treasury rate and the 30-year fixed rate mortgage was at about 265 basis points. The average spread in 2019 was 180. It's come down to about 235 right now, but that still suggests there's more room to go in terms of that spread narrowing. So we've had to bump up our expectation for refinancing to $1.9 trillion this year, and still another $1.1 trillion next year. Purchases about $1.25 trillion this year, and over 1.3 next year because of that drop in rates. We think you'll see rates down around 2 3/4 when we get to bottom.
Hey, one of the common questions that folks that invest would ask someone like myself is, what keeps you up at night? And and so as a forecaster, I'm going to ask you a question that I commonly get asked about running my business, which is what keeps me up at night. Doug, in terms of forecasting, what's keeping you up at night right now?
I anticipated that our board of directors would ask me that last week when we had the board meeting. And so I showed them a chart. I'm an economist, so I have to show a chart. And what that chart shows is from the peak of employment before each recession, how long does it take after the recession to recover that level of employment? The last 4 recessions that we've had, each recession, it has gotten longer and longer. So even though this was the longest economic expansion we've ever had, it also took the longest of any post-World War II expansion to recover that pre-recession level of employment. I really worry about how we're going to get back all those service sector jobs and whether or not there's going to be some underlying social turmoil that will be augmented by the very slow return of that service sector employment. And I don't know why it is that has systematically been expanding, but I think that there's some warning signals in that data.
So one of the questions right now, the Fed obviously has been aggressive since the very beginning. They've thrown almost everything at it that is in support of monetary policy. And Washington, to this point, has done fairly well. As you're looking now kind of at the next chapter over the next 30 days, how important is it that we get another stimulus out to all of those that have been affected at this point?
Well, there's no question that that is a lifeline for a lot of folks. And of course, you've seen, if you track the restaurant data, for example, which is where there's a lot of hourly wage workers or theaters or airlines, you can see the business has not picked back up, so they're not going to be hiring those people back anytime soon. So that $600 a week that folks are getting, I think there's going to be something done in that area. The debate is around the fact that in some states, the level of unemployment insurance benefits, adding in that $600 a week, actually means workers are paid more than they were on unemployment. They're paid more than they were when they were working. And so it's an incentive for them not to go back to work. I think that's one of the rubs between the White House and the Congress that they're trying to sort out. But I think we will see something.
Yeah, if nothing else, it's felt like whether it was all perfectly targeted, of course, whenever you do things in the middle of the night, which is what they've been doing, simply because of the nature of how this COVID came about, it just happened and caught everyone off guard to a great extent. It felt like that the stimulus, after the Fed, the stimulus has at least created a kind of foundation for some confidence to maintain. And that has been the thing that I've been thinking about recently. If we don't offer another round of that, where do we go? Does the shoe drop, and do we see, kind of more fear ending up in the marketplace? I know you've got to go. I wanted to ask you if you have any final thoughts, first of all, that you would offer to us with regard to housing specifically in the second half of this year.
Well, the interest rates are not going to go anywhere except down, so that's going to be a support. The biggest concern is whether or not the reduction in employment in the service sector and hourly wage workers moves over into the salaried space, because some of those businesses don't see recovery, so they start laying off management, which is often salaried. And then at the state level, most states have a balanced budget requirement. And if they need to lay people off, a lot of those people are salaried workers and homeowners as well. So I think that's where the risks are. The good news is that it seems early in this geographic shift of the virus that the hospitalization rates, while they're rising, haven't been as strong as they have been in other sectors of the country, and potentially suggests that we'll make progress through this without another complete shutdown. All of that is helpful for housing. So we'll just have to watch the virus.
Hey, last question, Doug, and I always ask you this, is if you were talking to your son or your daughter in the middle of this event right now, right where we are in the middle of July 2020, knowing everything we know, is it a good time to sell your home, a good time to buy a home?
Well, it goes back to your family budget. If you've got a family budget, and I hope you do, at today's interest rates and with what you know about the stability of your employment, if it fits the budget, you have reasons to be confident about the stability of your employment. It's a pretty good time to buy a house, but just make sure that it's a prudent, well-reasoned decision.
Well, listen, I regularly pray for you and your family. I'm grateful to know that those prayers have been answered to an extent, particularly with Mrs. Duncan, the boss in your household. I'm going to pray for you additionally about that, but I'm also going to pray for you with regard to your forecasting going forward with the challenges that exist. Thank you so much, by the way, Doug, for being a part of our program this morning.
Thank you, and thank you for all the prayers. They have been effective. We cherish that. Thank you.
All right. God bless.
You as well.